A lot of times when people look for a stock to buy, they look for the dividend yield. And that's because we want to feel like we're getting something back early on for our investment. But dividend yield doesn't really matter. And I'm going to show you why. So here's a test for you that most people will probably get wrong. Let's go back in time and imagine that the year is 2013, Blurred Lines is #1 in the Billboard chart, you can't stop dancing, and you're about to invest $10,000 into a stock. You look at two well-known companies that you're interested in. One is Verizon, your cell phone provider, and the other is Lowe's, your favorite home improvement store. So you already like both companies, and when you compare them, they look like this. And so for Verizon, they have a share price of just over $50, a price to free cash flow ratio of 5.33, a price to earnings ratio of over 58, and a dividend yield of just over 4%. Now with Lowe's, they have a share price of $41.06, a price to free cash flow ratio of over 14, a price to earnings ratio of over 18, and a dividend yield of 1.56%. And so when you look at these, it's not crazy to think that you might be more attracted to Verizon. They obviously have a good dividend yield, but even when you look at measures like the price to free cash flow ratio, it seems relatively cheap. And what if I was able to go back in time and tell you I'm from the future and I can tell you that in 10 years, Verizon's going to have a dividend yield of 6.98% and Lowe's is going to have a dividend yield of 1.86%. It seems like a no-brainer, right? Verizon all the way. Well, so if we come back to reality, the year is 2023. We're not even allowed to listen to Blurred Lines anymore, let alone dance to it. And if you had invested in Verizon and reinvested all your dividends, you would have ended up with a whopping 1.58 annual average return over 10 years. So that's a grand total of $1,700 on a $10,000 investment over 10 years. And that includes your dividends that you were getting the whole time. So wait, you started out earning 4% a year in dividend yield, but then ended up only averaging 1.58% return? How did that happen? So the answer is yes, and it's because the value of the company and the value of your shares kept going down. But hey, you can't win them all, right? So what about Lowe's? They probably did worse. Well, not quite. Had you invested in Lowe's, you would have averaged over 20% annual return and had an account worth over $64,000. And not only that, the amount of dividends that you got from Lowe's would have actually been more than you got from Verizon, even though their dividend yield is a lot lower. And if you're confused or you don't believe it, let's explain how that can happen. While everybody tends to focus on dividend yield, they're not looking at dividend growth. When a company has consistently strong dividend growth, it usually shows that they're able to generate increasing profits and distribute part of those increases to their shareholders. When they can do that over a period of time and keep a healthy payout ratio, it shows their financial strength and stability as an investment. So if we go back to our 2013 example and we compare the companies as it relates to dividend growth, you can see that Lowe's is multiples ahead of Verizon in terms of their growth rate. And even though Verizon's numbers aren't terrible, they're just not in the same ballpark as Lowe's is. And when you fast forward back to today, 10 years later, Lowe's is still sustaining that same dividend growth rate, whereas Verizon has gotten even worse. Now, obviously, when you're looking at stocks, just looking at the share price or the dividend yield or even the dividend growth isn't enough information for you to make a smart decision. It doesn't tell you everything about how well a company's doing or how they're executing, but looking at the dividend growth can give you a glimpse into how healthy the profits of the business are and the management's willingness to share those profits with shareholders. And really, I just wanted to show you the impact that dividend growth can have on trying to build wealth over a long period of time. So just because a stock doesn't have a really high dividend yield doesn't mean that it's not a great addition to your dividend portfolio. And even if we look at Warren Buffett's portfolio at Berkshire Hathaway, out of the top 10 companies he owns that make up over 93% of the portfolio, only one has a dividend yield over 4%, and 5 of them have dividend yields under 2%. Now, I will say there is one caveat that I want to make sure that I cover. If you're close to or at retirement age and you need the income to live now, then finding companies that have a strong dividend yield as well as stability and a long history of paying their dividends probably should be your priority. At that point, you need the money now to live, so it's not really about long-term returns. So dividend yield makes sense in that case. But if your time horizon is 10, 20, or even 30 years, then looking at dividend growth probably makes more sense than looking at dividend yield. And this idea isn't something that I'm just researching or having an opinion on. I'm actually using it with my own stocks. If we take a look at my own dividend growth portfolio that I'm building, you can see that while most of the dividend yields of the companies I bought are under 2%, the dividend growth rates are all above 8%, with the exception of 2. And those 2 were outliers. I bought Valero with the assumption that they'll get back to their dividend growth in the next couple years, especially when you look at where they were at in the 10-year. And I bought Walmart recently, but I broke all my criteria rules when I did so. I'll have more on that in my next video though. But the point is that quality dividend growth is a much better indicator of long-term success with a stock than dividend yield is. We have to fight the urge to buy the thing that looks good to us right now and gives us the most immediate benefit, and try to keep finding those things that will continue to look good for years to come. And look, it's not always going to be perfect, and we're not always going to pick the right things. But if we keep focusing on companies who constantly pay and grow their dividends at a rate that's higher than inflation, we'll be well on our way to building a portfolio that creates an income that grows with our needs so we can live whatever type of life we want. Now, if you guys are interested in understanding how I pick the stocks in my own portfolio, click on this video right here where I talk about the 5 totally free tools that I use to evaluate stocks. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking those wins, and I'll see you guys in the next one. Peace.